Hello and welcome to our second session, which is on stock valuation. Now, when it comes to stock valuation, typically stocks, also known as shares, form the fundamental units of a business. Now, stocks represent the ownership stake of the actual owners of a business. Now, this session will look at the valuation methods for stocks. Now, at the end of this session, students should be able to understand that the dependence of stock values usually depends, or the dependence between stock values and future dividends and growth of a firm. They should be able to compute stock prices using the dividend growth model, and students should be able to compute stock prices under different growth scenarios. Now, we're going to look at the basic stock valuation approach, and then we're going to look at stock valuation in different growth sessions. Now, let's look at the basic stock valuation approach. When an investor buys shares or stocks, they normally receive cash in two ways, and that has to do with the dividends received and the price received when the shares are sold, and then the capital gain or capital loss, if any. So as with bonds and other investors, the price that you offer for the stock is normally the present value of the expected cash flows, i.e. the dividends and the capital gains. So that the dividend an investor receives when holding a stock or shares, it depends on whether it's undergoing zero growth, constant growth, or differential growth. So let's see how that plays in. Now, in the event that a firm is undergoing zero growth, what it means is that the dividends will remain at a constant level forever, all things being equal. Meaning that dividend for year 1 is the same as dividend for year 2, and it will be the same as dividend for year 3, and continue indefinitely. Now, since the future cash flows are constant, the value of a zero growth stock is the same as the present value of a perpetuity. So in this case, we are not using other terminologies, but we're going to refer to it as the price of the stock today is the dividend divided by the required rate of return, and we already know that the required rate of return is a reflection of the risk profile of the firm in question, hence that which the market requires for putting their money into such an institution. Now, in the event that the firm is undergoing constant growth, it means that the dividends will grow at a constant rate G, assume, for ever or for the indefinite period to come. What it means is that dividend at the end of year 1 will be the most recent dividend factored into the growth rate that the firm is experiencing, and the same will therefore hold that dividend for year 2 is going to be dividend for year 1 growing at the growth rate of the firm. And so this can be represented by the basic compounding factor, where we can make that dividend for year 2 therefore is dividend for 0.0 into 1 plus the growth rate to an exponent of 2, and that continues for the indefinite period. Now, since the future cash flows grow at a constant rate forever, the value of a constant growth stock is the present value of what we refer to as a growing perpetuity, given by the formula P0 is equal to dividend 1 divided by R minus G, where R is the required rate of return and G is the growth rate of the firm. So now let's look at a constant growth example. So we look at Big D Incorporated. They just paid 50 cents in terms of dividend. Now it's expected to increase its dividend by 2% per year. Now, if the market requires a return of 15% on its assets, given the risk level, how much should the stock be earning? Now, we've got all the variables in question. We've got dividend that has just been paid, reflecting D0. We've got the growth rate per year, and then we've got the R. So incorporating that into the formula, then we are going to be able to determine D1, which we are going to grow as the 50 cents into 1.02, so 1 plus the growth rate, divided by the R, which is the required rate of return, less the growth rate. And that tells us that the current price, or the price that the stock should be selling for, is 3.92 USD. Now, the relevance of stock pricing in general has to do with the fact that On being able to determine the price for which a stock should trade for, then you're able to determine whether a stock is worth investing in or it's about time you divest, because then if the price for which it should be selling for currently is lower than what is on the market, then it means that the stock is actually overpriced because it's selling for a higher price than it should. So if you've got investment there, you want to step out before the market finds its level. On the other hand, if you do your computations and realize that it's supposed to be selling for higher than it is selling, you would want to cash in now, buy, and then hold it for it to see that appreciation, and then you sell to make some capital gains. Now let's look at the differential growth case. Now this is normal in the sense that in a typical setting, businesses grow and then they settle into a constant growth mode. So during the growth phase where they're seeing exponential growth, what it means is that all things being equal, their dividends will also experience that differential exponential growth pattern. And so what we need to do is to estimate future dividends into the foreseeable future, then look at the stock price when the stock becomes constant growth, so you refer to case 2, and then we'll be able to compute the total present value of the estimated dividends and the future stock price at the appropriate discount rate. So now let's look at an example that will clearly illustrate our point. A common stock just paid a dividend of $2, so that reflects our D0 or our D0. Now the dividend is expected to grow at 8% for 3 years, and then it will grow at 4% in perpetuity. Now what it means is that for years 1, 2, and 3, the dividend for that firm is expected to grow at 8%. Now starting from year 4 into perpetuity, the dividend will settle into a 4% growth. Now what that means is that with a discount rate of 12%, we are going to grow the dividend that will be paid for years 1 given by the computation, and years 2 as well as years 3. Once we get the year 4 dividend, looking at our case 2, we should be able to determine the price for year 3. And once we're able to determine the price for year 3, then we'll discount the cash flows or the dividends to be received for years 1, 2, and 3, and the price to be received for year 3 together to arrive at the present value for the stock. So then you can see that beginning year 4, we could value the dividend as a growing perpetuity to reflect the price for what? Time 3. And so this is what we have: dividend for years 1, 2, and then dividend for year 3 also discounted, and the price for year 3 also discounted, given as a present value, a total present value of 28.89, and this should be the selling price of the stock on the market. So typically these are how we go about valuing stocks depending on the kind of growth that the firm's dividend is experiencing. Now, how do we estimate the parameters? Typically, the value of a firm depends on its growth rate and also the required rates on the market, which is known as a discount rate. Now, where does G come from? G typically comes from the retention ratio and the return we can make on retained earnings. So depending on how much we retain from profits and how much we can return by putting those earnings to use, that determines the G, or the growth rate of a firm. Now when it comes to R typically in terms of return dynamics is made up of the dividend yield and the growth rate, basically in terms of appreciation or in terms of price gain or price loss, if any. So in practice, there's a great deal of estimation error when it comes to estimating R, because then you're using information that may not always reflect the available elements or dynamics on the market. So then, if we want to find the required rate of return using the dividend growth model, then this is a case where we've got price today under the constant growth formula to be given as D0 into 1 plus G. And so once we solve for that, we have a case where R therefore is the dividend yield plus the growth rate that the firm is experiencing. When it comes to valuing stocks, you should know that if a firm elects to pay lower dividends and reinvest the funds, all things being equal, the stock price may increase because of expectations also of future dividends. Because if the money is being reinvested in the firm, all things being equal, we expect the firm to grow and by that growth pay out more dividend. So we need to understand some of the basics here. The payout ratio normally reflects the fraction of the firm's earning that we pay out as dividends. Now the plowback ratio or retention is usually the fraction of earnings we retain for the firm to reinvest to grow the business. And therefore the sustainable growth rate is the steady rate at which a firm can grow, normally captured as the return on equity times or multiplied by the plowback or the retention ratio. Now, growth typically can be derived by applying the return on equity to the percentage of earnings that has been plowed back. So that's already indicated. The growth of a firm can be captured as the return on equity multiplied by the retention or the plowback ratio. So when it comes to valuing stocks, you can and then also look at the possibility of values of stocks before and after plowing back decisions are taken. So this is an example you can try your hands on where there is no growth and where we have growth. You can see the appreciation in the price of the stock. And so try your hands on this example and then begin to understand the issues of stocks better. Now these are some basics as far as stock market reporting is concerned. Just getting to know some of the basics that within the past 52 weeks, if you were to read the data on stocks, it tells you the highest that has been attained in terms of the price of the stock at the end of a trading period or a day, and then the lowest, and then the name of the stock, and then the symbol to be used, the dividend that it's paid, and then the yield, the price earnings ratio, which we have looked at under ratios, and so you can refer to that accordingly, and then the volume that has been traded, and on a particular day the price at which it has been. So on the day that this record was captured, this is the closing date, and if there has been any change in terms of the previous closing, the trading amounts at the close of the day and the current one, it will be captured accordingly as the net change. So that has to do with the information in relation to stock market reporting. And so that's what we have to address here. Now let's go on to look at, so what really, if we're saying that stock prices can be affected by a host of things, does it mean that one should be able to predict the pattern of stock price movements? In reality, the movement of stock prices from day to day do not reflect any predictable pattern. So statistically speaking, the movement of stock prices are referred to as random. So then when it comes to stock prices, we refer to that as behaving according to the random walk theory. Now look at a pattern. Now, even though the pattern is upward sloping, you can see that from period to period or from day to day, the actual trend can be, or the actual movement can be quite erratic, on days rising and on days falling. And so it becomes quite difficult sometimes to predict how a stock will behave from day to day. In that regard, then, how the stocks actually behave to a large extent also fall under what we refer to as the efficient market theory. Now, in an efficient market, what typically it means is that the stock prices reflect relevant information. So in this regard, we've got three main categories of market efficiency. We've got the weak form efficiency, where prices reflect mostly historical information, that is, all past information in terms of pricing and others reflect in this market, and so when you got new information, you could actually make some gains from that. When we've got a semi-strong form efficiency within a market, what it means is that the market prices of stocks reflect all publicly available information, not just past or historical information, but even present and publicly available information. In the strong form efficiency, markets reflect all information, be they public or private. And so it is quite difficult that in a strong form efficient market, you cannot make abnormal gains because all information that can affect stock prices have already been reflected in the pricing of the stock. So yes, you will make gains by investing because prices may rise from day to day, but you cannot typically outperform the market over the long run in a strong form efficient market. So this is just to look at a bit more elaboration on the weak form market hypothesis. So all security market information, the sequence, historical sequence of prices, the rates of return that have been given, the trading volume, and other market generated information. So that what it means is that past rates of return and other market data should not necessarily predict what the future may hold. Now when we come to the semi-strong form, it means that current security prices, all public information is gathered in the including market and non-market information. So the meaning is that decisions made on new information after it's public, that means when the information has become public, the price immediately adjusts to reflect it. So once the information is public, you cannot make any gains from such information. And when it comes to the strong form, it means that all relevant information has been captured, and so no group of investors should be able to consistently derive above average risk-adjusted rates of return from such an investment. So that in all these cases, the main assumption is that the markets are perfect, so information is cost-free and available to everyone at the same time, which obviously we know comes with a bit of snags, and these are assumptions. So in the case where information is typically not always free of cost and not available to anyone, at periodic times some may be able to beat the market, but in some cases may fall short of that. So what it means is that when it comes to fundamental analysis, using research to interrogate investment or financial data of a firm would not typically yield any information that is going to beat the market. So these are some of this reflection of how the efficient market theory made. So in looking at the days to the announcement, immediately the announcement is made, there is a reflection because the market adjusts accordingly to the new price. And so these are questions that you could look at critically in relation to both sessions 1 and 2 and answer a few of these questions to be able to understand better the issue of bond and stock valuation. Thank you very much. We'll meet in our next session.